They called it tulip mania. Every Dutch man, woman, and child wanted one, and wanted one badly. They traded anything and everything for just one exotic plant. The frenzy continued from 1634 to 1637. However, it would not last. Interest eventually declined, and with it the flower's value. Many who had invested in tulip stock soon found themselves penniless, sending the economy into a years-long depression. As the Dutch can attest, stock market crashes are nothing new. However, their causes and effects can vary. There have been 4 major stock market crashes so far in America's history. The first of these was the crash of 1929. It was preceded by the booming economy of the 20s, when everyone was snatching up fancy homes and trendy automobiles, and those playing the market were borrowing obscene amounts of money. Due to these conditions, markets soared, reaching their highest points in August of 1929. But even then, there were hints of an impending catastrophe. Production had begun to taper off, unemployment levels were on the rise, and the widespread debt, along with countless loans, combined in a recipe for disaster. October 29, 1929 became known as Black Tuesday. It was a day of widespread panic. Investors traded millions of shares, resulting in a loss of billions and the bankruptcy of many. Its aftermath pushed an already faltering America headfirst into the worst economic fallout of its time. Thus began the Great Depression. Its effects were devastating. By 1932, stocks had fallen 89% and had all but completely lost their value. By 1933, 30% of the population was unemployed, leaving 15 million struggling to survive. Thanks to President Franklin D. Roosevelt and the jobs created by the Second World War, the economy eventually recovered. However, the Depression had lasted more than a decade. The second notable crash was in 1987, again in October, and was dubbed Black Monday II. It was caused in many of the same ways as its namesake, with a new contributing factor: technology. On October 19, 1987, as investors began to frantically sell their stock, they were able to do so at unprecedented rates thanks to the use of computers. When all was said and done, the market had sunk 23% in a single day. It was the biggest drop in stock market history. Overall, the market had lost $1 trillion. To put this in perspective, the market was out $14 billion in 1929. However, unlike the earlier crash, the economy of 1987 recovered quickly when the Federal Reserve intervened. Technology was again a culprit in a third major stock market crash of 1999 to 2000. As indicated by its name, the crash was much larger than a one-day affair. Problems began with the rise of the dot-com market and technological giants such as Globe.com, GeoCities, and AOL in the 90s. Stocks in these companies initially soared, far surpassing their true value, only to be sold off by investors and plummet to all-time lows. Globe.com shares, though offered at $9, were bought up at $87 on opening day. 2 years later, they were purchased for less than $1. It was not only the tech giant affected, investors were in a hurry to sell any and all related stock. As a consequence, the Nasdaq would fall from 5,000 to 1,000 in the span of a year. After this crash, investors learned to critique tech company stability and exercise more caution when making a purchase. Last but not least was the crash of 2008, leading to a recession and just narrowly avoiding a full-on collapse. This time, problems arose beginning in 2006, with the decline in housing prices and an increase in homeowners unable to pay their mortgage. This resulted in the bankruptcy of several financial institutions. In this instance, Congress intervened with bailouts for select banks and by manipulating interest rates so they stabilized around 0%. 2 years later, the stock market began to make a recovery, though it did so slowly. As evidenced by history, crashes can occur in a day or over the span of a year. Their recovery can be quick or draw out for a decade. The reason for recovery varies as well. So, what does all of this tell us to expect if, say, the market were to crash tomorrow? Truth be told, we should expect that history would not repeat itself exactly. The chance of collapse should not only be less likely, but its effects should be less severe as well. The reason for this is that there are now safeguards in place to prevent disasters on the same scale as in the past. A key to prevention was and still is panic. It all starts when people feel less uncertain about the market due to any several number of reasons and sell their stock. In normal circumstances, this has no great effect as it'll be bought up by someone else who has more confidence. However, as was described by each of the 4 historical crashes, there was a profound absence of any faith in the system at all. In other words, there were only sellers and once sold, no buyers to restore balance. In these instances, the first nervous few soon led to more and more nervous individuals. levels, resulting in a free-for-all dump of any and all shares. When this trend continues, it has devastating consequences, as in the crash of 1929, when stock lost almost all of its value and the economy tanked for years. America has analyzed these past events and learned from its mistakes. Now, when the Dow drops by 10% before 2 in the afternoon, trading stops for an hour. If the Dow drops by 20% by that same time, trading stops for 2 hours. Trading ends the day if the Dow declines by 30%. This is meant to prevent widespread panic and emotion-based trading. Further, if the case of a major national tragedy or similar event, markets may not open at all. In these situations, it's easy for many to make rash, unwise decisions that are difficult if not impossible to recover from. However, although these new procedures are without a doubt beneficial, another large crash is possible. If somehow this were still to happen, it would affect many people from every walk of life. Companies without an income from stock would make cuts where they could. Unnecessary expansion and further development would be on hold. Businesses would also try to save, which could lead to cuts in the workforce. Unemployment numbers would rise. Those hoping to retire might find that the worth of their 401k has declined and they must work longer than expected. However, as is evidenced by history, even the most devastating declines don't last, although it may be slower than many would wish. Bottomed out stock prices have nowhere to go but up. For this reason, those who hold on to their stocks and resist the urge to sell will be pleasantly surprised as they recover their losses. Riding the tide and remaining calm is imperative when it comes to the stock market. It will also prevent things from getting worse and could make the road to recovery possible. So, what do you think? Is it likely that the market will completely crash again? And if it did, should we panic? Let us know in the comments. Also, be sure to check out our other video called "What if the USA paid off its debt?" Thanks for watching, and as always, don't forget to like, share, and subscribe. See you next time.